Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi, good evening everyone. Hi, thanks for coming to the new venue. Hope you like it. So just like last time, we have teams in Bangalore and Delhi, and we are live casting it to both the teams out there. So say hello virtually to everyone. They cannot see us, just. Okay, before I start, how many Breaking Bad fans in the audience? 1, 2, 3. Nice. 4. Look, you guys are busy making money in the stock market, right? वो अलग बात है. But I mean, if you're losing, then you want entertainment, yeah, to calm yourself. Although this is not calming entertainment, but still, it's good entertainment. So any guesses what topic for the day? So forget Breaking Bad. अभी हो गया, 4 लोग ही है. Yes. Who is that? Nice. So we'll talk about chemicals today. Not the kind of chemicals these guys were cooking. Although we wish that were a listed business. I mean, they started marijuana. Who knows? I mean, there might be a trajectory there. So what's a good investment return according to you in the 10-year period? Okay, a return that will make Mr. Walter White ashamed of himself for going into crystal meth. Okay, the suspense is killing me, so I'll just tell you. So some numbers out there, 31% CAGR, 53% CAGR, 19%, 29, 43. Seemingly random numbers, but decent returns, right, over 10-year period. So I'll come back to this slide, so don't try and read everything. But there are some of the companies listed in India, in the chemical industry, who have generated in 10 years these kind of returns. And there are many more. This is a randomly picked biased list of companies which I thought will be interesting, which will fit in this size. So my whole intention for today's presentation was to understand whether the chemical industry, the sector as a whole, is a good sector to track from a business owner's point of view. So is it a good business to be in, first of all? I mean, there are businesses like a Bania or a retail or IT. There are some good businesses which you know that they make consistent cash flows and they make money for the owners. But is chemical industry that kind of an industry? And what we saw was a 10-year stock market return. That does not mean promoters would have made the same amount of money. They may have also lost money in the entire cycles that they have seen. So the challenge was to see that if yes, then how can we make money in the chemical sector as a business operator in the chemical industry? And if it's not possible to make money in the chemical sector, then what are the reasons that we can't make money in the chemical sector? So a few years back, those who were in the audience or those who have seen it on the YouTube channel, I spoke on the pharma sector and went quite into depth of how the pharma sector operates and what are the inputs and outputs, what happens in the industry. So because I did that, I thought that it will be a very easy thing to figure out how the chemical industry works. So I put this diagram out. So, okay, what's the process? There is this raw material, which is also known as feedstock, which goes into this structure, and there's some chemical reaction should happen, and it is shipped out to the customers. It should be that easy. But let me take a detour for that. So forget the chemical industry, but regardless of that, if you get your hands on this book, it's readily available. It's called The Knowledge Illusion. There's only one concept in this book which I found to be the best concept I've seen from an analyst or investor point of view, the illusion of explanatory depth. The entire book talks about how we think we know more than we actually do, and which is all right. I mean, the overconfidence sometimes helps us in taking risks which we are not supposed to take, but sometimes it also creates losses or opportunity for total catastrophic failure. So this concept has a very simple experiment, and it is part of a research paper to prove that we actually don't know what we're talking about many times. So I said, okay, since I think that I understand the chemical sector so well, now let me go and use this concept of explanatory depth on myself and my own understanding. The experiment is very simple. On a scale of 1 to 10, I asked myself, how well do I understand how the chemical sector works? How well do I understand it? All right. So now I rated myself 6 in my mind at that time. Next step is, okay, now it's time to describe in excruciating detail each and every single part of the operation of how the chemical sector works. That's where the problem began. Because I knew that there is not one chemical. There are hundreds and thousands of chemicals out there. Now which part of the chemical industry do I pretend that I understand well? Some understanding of the pharma sector was there because it's a fairly easy thing, because you already get the API and all you are making money on is selling the formulations. Very few companies actually just sell the API and make money on that. But the majority of the pharma industry makes money on the final medicine, the pills, the IVs, all those things. That's called the formulation. So that was easy to understand, but who knew that we had to also understand for the chemical industry what goes in the API, what goes into the intermediary products of the chemical sector. So once I started to answer this question to myself, I realized that, okay, that scale of 1 to 7 and I scored 6 on that in my own mind was wrong. So immediately I went to step 3, and now on the scale of 1 to 7, rate my knowledge on how the chemical sector works. I gave myself a modest 2. Did not give 1 because I knew a little bit more. So this is a very interesting framework if you want to try it out on any sector or anything you want to try, anything in your life. So how does a can opener work? If you want to test your knowledge on that, do the experiment, rate yourself, actually explain on a piece of paper how it works, and then rate yourself again. So again, since I enjoy simplicity, I said, okay, how does any business work? You take capital, you devise a strategy of how to run that business, you create a supply chain to execute that strategy, and then you converge to the demand where customers are, and hopefully you make profits and you repeat the cycle. But in the chemical industry, it's not just one cycle. If you are a diversified chemical industry operator, you will need to follow multiple cycles of multiple products. And hopefully if you are of the right mind when you started the business, you will be in reasonably allied categories rather than disparate categories. So I routinely keep going back. When I track cyclical companies, if I want to understand something just as a framework, I go back to these 2 books. Sadly, this one is out of print. So if you have a friend who has a copy, kidnap him, ask this book for ransom and read it. And this book is readily available, so no kidnapping required. So these 2 books are fantastic to understand the capital cycle style of investing. So the first book, Capital Account, which ranges from the time period of 1993 to 2002, which is the Marathon Asset Management's letters, which were now edited and put into this book. And the second book goes from 02 to 15. What is interesting is, if you look from a business operator's point of view, the cycle or capital cycle is quite simple. You have put up capital, you set up a business, and you are making decent amount of money operating that business. But when you realize that your returns are rising above the cost of capital, your business is doing really well, other people also notice that your business is doing well. And God forbid, if you are in a commoditized sector where it's very easy to copy your business model, the new competitors will actually pour in their capacity, which will make sure that your returns will reduce, or the average returns of the industry will reduce. Then the rising competition will actually cause the returns of the entire business to be below the cost of capital. I mean, if you can borrow money at 10% and you're making ROE of only 3% or 4%, it's not viable to continue to do that every time. You need to raise capital at a higher rate and you cannot sustain. So eventually the business goes into decline, the industry consolidates, many firms and competitors exit the market. And then again, your capacity suddenly starts gaining value because you are the only player left if you are alive. So this cycle continues to repeat, and any business operator really understands this when he puts up capacity in a chemical sector or a cyclical industry. But investors look at it in a different way. When everything is going well, when everything is at top of its cycle, we suddenly see earnings growth in a phenomenal rate. We suddenly see valuations peaking, and the momentum traders and all of us wake up suddenly one morning and say, "Nahi, aaj to isme invest karne ka." I want to become like Walter White one day. Only 5 people in the audience will get the joke. I understand. I'm okay with that. So you go up the cycle, and you eventually lose money when the cycle collapses on us because we are not ready to understand how the cycle actually works. So there started my journey to understand this cyclical industry from a oversimplified chart with a cute truck to really understanding this is what the chemical industry actually looks like. So this chart is deliberately complicated with different colors. But if I showed you the original chart which I made this chart from, you would not attend FOF afterwards. So let me remind you today why you guys did not take science, or those who did and became analysts, you'll go back to your school days or college days. So let me remind you how the chemical industry works. This is basic chemistry. There's no rocket science. I'll put up the slides on the YouTube link, so no need to take photos. It's chill, relax. Sadly, I don't have any of the substances I showed before to make you relax, but might as well. My soothing voice might help you. Anyway, so, okay, ready for the science class? So on the top you can see 3 boxes: inorganics, oil and gas, industrial gases. How many of you know that organic compounds or chemicals are made up of carbon and hydrogen? Basic school math. Okay, one person. The derivatives of these products. Inorganics is everything else which does not have that C and H bond in that. So everything else, right from your minerals, salts, ores, whatever you know, all chemicals that you can think of, which is not made out of carbon-based thing, comes into inorganics. Now, this particular belt over here, industrial gases, obviously, you know this by obvious things, nitrogen, oxygen, some of the gases which are used for processing, manufacturing processes. So these 3 items are known as the raw material or the feedstock at the very base level. So which you call upstream. At top of the raw material food chain is all these 3 items which go into the chemical process to create these stuff in between. So you have derivatives coming out of this. You have salts, carbonates, ores, which are used to create fertilizers. Then you have chlorine gas, soda ash, titanium dioxide. I'm just putting these names up because these are very common chemicals, silicon, which we know of. These are used to create specialty chemicals. Then you have the derivatives of the organic chain, which are made to create specialty chemicals, your crop protection chemicals, your pesticides, herbicides, all sorts of chemicals. These waxes, fuels, lubricants are also used to create specialty chemicals. Even these gases are used for various processes. Now you can suddenly see that the complexity of the molecules created or the products created starts increasing as you go down this chain. Over here it was very simple. You had a simple base minerals or items together, you collide them in a reactor, you create these intermediate stuff. This intermediate stuff eventually becomes slightly more intermediate stuff, which is a more complicated formula. So if you're imagining the quadratic equation which we did in schools, you had a binomial or a polynomial, it keeps on increasing in size. So imagine that complexity constantly increasing with each step you take. And eventually you have the things that we know regularly that we use, toothpaste, shampoos, which turn into consumer chemicals. So whatever stuff that we touch every day is part of some of these derivatives. So as we keep going down from these basic raw material feedstock to the real applications of all these chemicals, that means you're going downstream. Okay? And if you're going up, you're going upstream. So you may have heard managements talk about we are backward integrating or forward integrating. So you might be somewhere in this space, and when you say you're backward integrating, that means you're also going to process your raw material from now onwards. So you'll provide your own raw material to yourself. And when you say you're forward integrating, one of these guys upstream will say, now I'm tired of making all this commodity stuff. I really want to make something specialty. So I'm forward integrating and putting my own capacity to make some more money. So science lecture successful. Did you guys get it? Nice. There's no energy in the room today. I might quiz you guys. So stay awake. Alright, so basic stuff, upstream, downstream. But now we know that something goes in, something happens here, something goes out. But imagine if you are a multi-product commodity player, you have to juggle a lot of supply chain complexity. Now it's no longer just a simple in-out, in-process out. Now it's like in, out, store, process, store, again distribute across various channels that you're running. And imagine how many chemicals you're actually going to make, how many products you're actually going to make. So each product will have its own unique supply chain needs. So you may not be able to put the same chemical in the same tanker and say, now sab kuch leke jao. It's not like you put mangoes and apples together in one cart and you say, okay, let truck go. These are chemicals, so they need separate handling. Each will have its own hazard rating or whatever. So based on that, you have to manage a very complex supply chain. Although supply chain to draw is very easy, but each item in the supply chain has its own cost associated to it. So each business has to now understand that the cost of manufacturing will be only one part. So you may earn some gross profit on just making the commodity, but now you need to find something to distribute it. Like in Breaking Bad, now 5 people in the audience will relate to this. They actually stole the raw material to make crystal meth, and they took that raw material and they made huge amounts of quantities of really good quality crystal meth. But then what to do with the crystal meth? They required a distribution channel. They required people to move the product. So you really need to move stuff. You need to find customers. You need to devise the entire supply chain. Like I said, from capital, business strategy, your supply chain planning to executive strategy, which meets the demand, which generates profit eventually. So simple so far, right? Cool. There may not be too much. I'm just asking you, right? There may not be that heavy concepts afterwards, so it's all right. It's just business, right? I mean, it's like any other business. You replace chemical with steel. So another good book which I really enjoy reading occasionally. So I'm not from a business family. So all my understanding of business is from reading about businesses, talking to managements of companies who started companies and run companies. And it's vicarious learning, observing other people run operations and getting their feedback, seeing how people behave in different cycles. And that's basically my background of investing and understanding a business. But in this book, apart from very good concepts, there's one good concept I really enjoy, and which any business operator knows intrinsically, that business blood, which they know, this is in their DNA, it is engraved in their DNA. So I'll walk you through this. It's not that difficult to understand. So you have value triggers, you have value factors, and you have operating value drivers. So Michael Mauboussin and his co-author Alfred Rappaport, they call this thing the expectations infrastructure. Don't worry about the name, it doesn't matter. It's just fancy because they are academics, they wanted to name it something, so they did. But it's a very simple concept to understand. To really grow your business's value, you require sales growth with profit margins and return on incremental capital. So to get sales growth, you need volume and price mix. So if you are selling something in a bulk quantity, then you can price it at a per unit lower level, say 10,000 or 10 million items for 10 rupees a piece will give you a certain amount of revenue. But if you are selling lower quantity, like 1,000 units only, then it better be a really valuable commodity. Like you're pushing an iPhone, you don't want to price it like a 9,000 rupee Xiaomi phone. I mean, it might happen eventually, but if you're moving an iPhone, you really need to price it accordingly. But if you're moving a Xiaomi phone, you need to get volume to make the same amount of money. So sales growth is driven by volume and price mix. All right. Now profit has 4 inputs. Clearly, price mix is one of them. That you price your product properly to get the profit per unit right for yourself. Then operating leverage is the concept you may have heard, but intuitively everybody understands it. For every incremental item you make or sell, you make proportionately more profit. That's what it means. So if your fixed costs are going to remain really fixed, all the profits for the next item that you sell is going to be directly going to the bottom line. Okay, it's a very simple concept. The more quantity you make on the fixed cost, the more items you sell on the fixed cost, the more profits you generate. That is only if your business has operating leverage. So operating leverage, price mix give you higher profit margin. Economies of scale is a concept everybody knows. There is a certain quantity that you need to manufacture to make the asset worth utilizing. So some companies have a utilization of 50%, which can start generating profits for them. But the optimum utilization they might want is 70%, which generates their ideal return on capital that they want. So each plant, based on each business and the supply demand in the industry, you will have economies of scale. And the last one is cost efficiency. I mean, if you can survive by not spending too much on your day-to-day operations, so the same amount of people, same amount of infrastructure can give you higher returns. It's a different way of talking about operating leverage, but in terms of itemized costs of what you spend. Like if you're using a factory, but you turn off 2 lights, you save some money. So that's a cost efficiency, you earn profit directly from that. So sales growth, profit margins, and last is return on incremental capital. So whenever you have surplus capital left, it needs to be deployed or redeployed in the business if there is capacity to deploy in the business. It can be redeployed by creating maintenance capex, or it can be redeployed by creating more capex. So you can expand your operations, or you can give it back to your shareholders as dividend, or you buy back shares, or do whatever you want. But each use of capital, the return has to be incrementally higher for you to deliver higher value from the business. So the business needs to continuously keep delivering on these 3 fronts for generating higher value. These are very basic principles in economics or any business. So it's not something rocket science. It just put in this context, it seems like it's difficult to understand. But since I'm not a business owner, I learned it this way. So now imagine if you have to map it across the entire supply chain, you really need to have good control over who your suppliers are and how much you can afford to pay them to the max of your ability. Each of the logistics items that you're using need to be optimally priced for you. Again, you need to find out warehousing cost, because each chemicals will have its own way of storing and requirements. Each plant will have its own designs and specifications. Nowadays, if you look at regulations, even effluents and emissions are being monitored very closely. So you need all these things to operate within this expectations infrastructure without compromising the core of your sales growth, which is volume and price mix. And even if you want to run the economies of scale, you cannot forget the cycle that we saw earlier, where are you in the cycle where your capacity is going to be used well or not? So if you are in the right cycle, you will make money. And God forbid, if you borrow money to reach there, really, God save you if you are in the down cycle. So the same thing which any business person knows, we have to map for each and everything in the chemical sector. And let me intimidate you once again by showing you the chart. So imagine you don't know where you are. If you are running a chemical business, if you're aware that your strategy 10 years down the line to say move up the value chain, which is what they say, for earning more profits by selling something incrementally better than what you're selling right now, or a processed item which you're not selling before, you really need to have that plan in your mind as to how you allocate capital. So the ROIC thing you saw, it's not a vacant number. It's actually a plan which you have to execute over a period of time and make sure you get the cycles right more than average. So, like any good analyst, if you really want to start digging somewhere, go macro. Because nobody cares. When you talk macro numbers, everything sounds good. So, just go macro, just dazzle everyone by saying, "Arey, ye itna bada industry hai, there's so much scope in this industry." Just talk to everyone about this number and confuse them. That, okay, how does it matter to me as an investor? But still, you have to start somewhere to understand the industry. So my idea was, can I build a map for myself? So one map was to understand the upstream and downstream economics. But do I really understand how the industry is sized? So I know that these people exist, but how big are these people? It's a good question to ask. So let's start with the first thing we saw, inorganics, on the top left of that hideous chart. So don't try to read it. It's just to impress you. The chart is just to impress you. The point is that some of the numbers are ridiculous. I had no idea that the chlorine market is a $150 billion market. And first of all, this debate about this $3 trillion number also. So this $3 trillion number, some people say it's $3.7 trillion. And both of these numbers are excluding the pharma industry. So if you add the pharma industry, you will probably get $4.7 trillion is the global chemical markets in terms of revenues per year. It's a huge market. And we have seen pharma, so I didn't want to add it again and bore you guys and bore myself. So look at these items. Look at these nitrogen-based inorganic compounds. Like $138 billion market. Fertilizers, $61 billion. I mean, these numbers are staggering. we look at companies in India struggling to make urea and stuff like that. I mean, you need subsidy to operate. All those numbers, when you look at the global industry, I mean, it's a huge industry in itself. So if you want to really track, the promoter has to have aspirations to make sure you're part of this industry on a global scale rather than just operating in a domestic country. And with each country has its own challenges. You have your tariffs, you have your export duties and everything. So it's interesting to figure out where everything stands. So once you have this mapped out, you know that which industry your company is operating in, and you can just work your way back towards where they are in the entire value chain. The next industry is the organics, huge. So total inorganics was say 482 billion. The organics is slightly larger, which is $582 billion. This I've split into two charts because the chart was too big to accommodate. So polymers and intermediates, which is the $800 billion market by revenue, is this next slide. But this slide again, you may have heard of chemicals called olefins. By the way, how many of you have invested in chemical companies? That's a good question to ask. 1, 2, 3, 4. Same number and same people as Breaking Bad. Interesting. That is good. Huh? Fans, yeah, true fans. True fans. Did you guys make money in the chemical stocks you invested in? Only one person made money. 2 people made money. Oh, nice. So you have competition with Walter White. So anyway, so again, olefins, people who understand, and you can look these words up. It's very easy to understand. I mean, not the olefin and the chemistry behind it, but what that compound is. It's easy to understand and where it is used. So every time you search any product, you just put the product's name, olefins, and applications in the Google search. And you get all sorts of information about where these things are used. So you can figure out the value chain yourself if you are an analyst and motivated to do that. So I'm just amazed. Some of these aromatics, olefins, these are like huge markets, 120 billion, 200 billion. It's just staggering. Polymers, some of these which are turned into plastics, our textiles and everything, these are all 160, 200 billion dollar market. And now when you put it into context of the countries which produce chemicals, now you know which are the large countries who have huge chemical capacities operational. And then you can realize now in the value chain where these countries survive and make money. This is the part which gets people excited a lot. These are the specialty chemicals, so-called functional chemical market, where everything that we talked about in the upstream gets trickled down with some magic formula and becomes into these very useful chemicals, which then analysts like me extrapolate on the Excel sheet that this market will be infinitely growing till Thanos comes. And it's amazing. Again, coatings, car paints, house paints, all these markets, a $118 billion market. It's mind-blowing. These numbers just don't make sense if you put it in a vacant context of not understanding how big the chemical industry is. And all these are derivatives from some of these items which you saw earlier. So if you are a backward integrated player, you actually save money by making your own raw material sometimes. So you have plastic additives, you have agrochemicals, you have catalysts, you have paint pigments, you have lubricants. All these things which we know and use every day are actually part of this huge global $700 billion market. In fact, a recent IPO of a specialty chemical company has some more data about the industry. So if you are really curious about where India stands, they have given some contextual data there. So I've used this term a lot of times, so it's time to reveal what it actually means in money terms. So like I said, if you go upstream, you have a feedstock which relies really on cheap sourcing of whatever stuff you are putting in to sell. Like if you are drilling oil from the ground or from the ocean, you better have the cheapest cost of operations to get the cheapest source for the feedstock, which then goes to a refining company to make into a bulk ingredient, which will then go into some chemical process somewhere. All you need here is cheap sourcing of that core raw material or ability to extract it at a very low cost and a scale of operations which rivals everyone. I mean, a player in India is as large to give Tashan to a Arab sheikh somewhere. So we have used scale in refining capacity. We are really a large capacity player in organic chemistry. Again, you need to have the right product mix. So not necessarily every feedstock that you create or every bulk ingredient you create is going to generate the same amount of money for you. Sometimes your waste is somebody's raw material. So you might actually end up selling waste which you don't want to process. Sometimes the cost of processing your waste is more than actually using it in the process somewhere. So a lot of people do forward integrate because they want to process the waste themselves and use it as a raw material in some other process. And that creates another supply chain within the existing supply chain that you have. So it saves you money, but at the same time, you may go in direction of a business you don't want to go in the longer term. So a lot of these dye companies or alkali companies, they have chlorine as a byproduct. Now, they may not want to use the chlorine in any of the processes, but some of them have made capacity expansions in areas where chlorine is used as a byproduct in the process, and they now make chlorine-derived products from that. So you have a choice, either to throw it as a waste or sell it to someone who wants to pick it up, or you use it yourself. Now, as you go up the value chain, now this is the same value chain horizontal, which we saw earlier. You make a little bit more money by differentiating between what you're selling. Now, differentiating can be made only on the basis of applications. So, where it is used, for example, and does it have an intellectual property with it? So, if you have an IP or a patent based on the process that you have or the chemical that you have created yourself. So, for example, you may have an original patent, and the patent family will have other patents which you have developed on your own with your own R&D. So, you need to spend money to actually earn money in the future to show some R&D expenditure over a period of time. So I think the global average for the pharma industry and the R&D cost as a percent of sales is about 8 to 10%, depending on which company you look at. Generic companies have now started to do 8%, 10% of sales as R&D. But in chemical industry, the global average I found was not more than 4%, which is interesting. So I couldn't understand. Nobody actually writes about why there is no scope for doing more R&D. So is it like they are lazy, they don't want to do R&D, or is it everything is already research? So that was the right answer. To the past 50 years, most of the chemicals have been discovered and their applications have been discovered, patented, patents have expired, and no new patents have been applied at the same volume as they were applied, say, 30, 40 years ago. So a lot of these technologies that we know of are now only driven by process innovation. So how can you make this process more efficient? If you can combine two less chemicals, if you can shrink your supply chain to some extent, you can save money in the cost efficiencies which we saw in the expectations infrastructure. So you keep using your IP again and again in some ways possible. You keep some differentiation. And there are tons of companies. So the entire functional chemical sector we saw, that entire wheel of companies which are available, products which are available, are all part of this small area of specialty ingredients and the final application of those ingredients. So in a coating, you may want a water-resistant coating. So it may have a different chemical process than a water-soluble coating. So all these things need to be made, and you can differentiate a product portfolio in coatings as such, but your end process remains the same. Your input to that process remains the same. So you differentiate, you create a distribution channel for yourself, you become either global or local distribution channel, and if you have IP, you can charge some extra money on that. And finally, when it reaches to consumer products, products that we touch every day, shampoos, toothpaste, and whatnot, ketchups, everything that we use, which are driven mostly by marketing, distribution, some branding efforts. And mostly people want to be in this category. So people want to be the 3Ms. They don't want to be an oil refinery person. Although 3M's adhesives will have something that the oil refinery has made at some point in time. But 3M will not want to go into the business of refining oil and then derive the product, make the adhesive, put it into that post-it, and which is sold at the retail store. They would really want to make the most amount of money on the technology at which the adhesive is made of. It's like the Coca-Cola formula. Nobody can get it right. So there are these stationery shops which sell counterfeit post-it notes of 3A, which is the label that they sell. And if you put it on the piece of paper and there's ink, God forbid there's ink underneath it, it will pull the ink. So it's a post-it and a magic tape. So, but 3M, if you use that adhesive, it will last. I mean, after 15 applications of posting and removing, it will still work. So it's a fun application, but they charge 35 rupees for that small piece of yellow stack of papers. That's marketing. Their distribution reaches everywhere. I can buy it in Dombivli, I can buy it in Karjat, I can buy it anywhere I want. And they have a brand, so everybody knows what a Scotch tape is, everybody knows what a post-it is. So they really have spent money, and that's why they make the big bucks. So 3M makes, I think, $1 for every $10 that they spend in terms of some of these very old products. So post-it, Scotch tape are like, I think, 30, 40-year-old products. I don't think even more than that in many cases. And they keep making money. It's free money given to them. So really you have to decide as an entrepreneur or an investor that which kind of a company you want to invest in. And it will have its own set of cost challenges. It's not like because you are in this area, you are exempt from the problems of this particular supply chain, but you have other problems to deal with. So you may be P&G, you may be Gillette or whatever, you may be HUL, You're making all these consumer products which have all these chemicals in them. But what if there is a retailer who creates his own private label and competes with you? He understands the same manufacturing process. So if you turn your shampoo bottle around, none of the products that are mentioned there are actually patented. They're all off-patent products. Anybody can go to a contract manufacturer, make the same copy, even copy the branding of that bottle and change the name on top of it. And you can sell the product as a private label in the retail store. So as chemical industry has its own value chain, retail companies have its own value chain. So private label will generate more profit for the retail company than the third-party product that they are selling on the shelves. So each company will have its own set of challenges, and it's very interesting to figure out once you are dropped into one of these places to know where the business is heading over a period of time. So coming back to this randomly selected biased chart of companies, which I like, don't try to read it. It's a small print, but it's interesting to see. So most impressive, of course, once you are sufficiently impressed by the returns that these companies have made, and you are sufficiently cursed yourself for not participating in any of these things, because you're not in the market when these companies were available at those prices. So, theek hai. You cry for a while and then you come back to the basics. You look at the annual reports, you open, what have these companies done? So, company like SRF, it operates in 3 segments. Now, in each segment, they have tried to do something innovative, but in one of the segments, they have done more innovation than in other segments. Although if you look at the fixed assets growth, so you might believe that, okay, every time they have grown by, say, 12% year on year for the past 10 years, profits have grown by almost 7% for the past 10 years, they may have also invested in more capacity expansion. But it's not the case. So they have capacity expanded only about 6% on a year. So you can see many companies, a few of them have really grown the capacity at a dramatic rate, which have translated to maintaining ROEs or sometimes declining ROEs. So, like I said, very few companies actually have the same ROE numbers that they had 10 years back. And because many of these companies have become more complex and more diversified in the products they are selling. And when they enter into each category will have its own set of cost issues and the value chain problem that they will face. So they may not be the best player to be in that industry at that particular value chain, but they may be the most scaled player, or they may be the player who has the capacity at the right time. Lots of reasons. So for example, so I deliberately put a chart for agri-chemical companies. So agrochemical companies are very interesting. They are technically specialty chemical companies, but they are dependent on a agriculture industry and the spend that a farmer can make, which is driven by distribution, branding, reach of the product. So although the compounds will have the same name, these are all off-patent products, but the farmer will know them by some local name, which they are used to buy every year as a fungicide, weedicide, or a pesticide. Some of these companies, so I put the starkest examples. I put one company which did phenomenally well, did 53% CAGR in 10 years. The profits grew by 28%. Fixed assets grew by 24%. And I did compared to one company which did not do so well, which is Rallis, which only grew sales by 9.5%, assets by 10%, and market cap by 6%. Now what happens when these two companies, no comments on the corporate governance, everything remaining the same. What happens? They are both in the same industry. They are aware of the economics of the industry. And yet, you would have gone with one player thinking that they have the best capacity to do in that industry as anybody else. But they did not take advantage of that at the same level as some other company may have. And actually, there's a huge list of companies which we can dissect in the same way, looking at, okay, why this company did it in a different way and somebody else. And the moment you start mapping their products and see where each product is in the value chain and which year they entered, you can now start zooming out and see where the global supply chain industry was. So were they sourcing the product from India? So a lot of the data that I have compiled to understand these companies is available publicly. So nothing is proprietary here. If you look at the trade data on the Ministry of Chemicals website, it's actually details, month by month data of exports and imports at each port. And what I realize is that India is a net importer of chemicals. All the raw materials that many companies are using are imported. And most of them are made at scale, which are the bulk intermediates of their use. They're made in China, or somewhere specialty are made in Japan, or somewhere in Europe if they're really special or patented. So all these products with their own supply chain issues. And if you would have read the newspaper, in the past 2-3 years, you would have read that China is cutting down on pollution and emissions and all those things, which creates a strain on the supply chain which you have not factored for when you entered the business. You would have said, like looking at that big donut and seeing that the industry is so large, might as well grow into it. Doesn't matter what the supply chain issues will be, but what if your ingredients are missing from the market? What if you have to pay 4 times more than what you decided to pay when you started the business? So all these issues have plagued all these companies, and the 10 years data will iron out some of these issues. At the same time, give you a very stark picture of where the companies were at one point of time. You guys are looking very ominous. Any questions so far? Let's do a discussion rather than me clicking on slides. The next slides are just some patterns which I've identified, which everybody generally knows. So what have been your experience from investing in the chemical sector? Anybody can say, is it different from what I'm saying, or have you learned something in a better way than which will help everybody else to learn faster? Any feedback? One second, getting the mic to you, 1 second.
Actually, out of this list, I wish I had invested in more companies. I invested in Vinati at 450. It's about 1800 today. And that's about 3 years ago. I think it'll go to 3000 in the next 2 years. So actually, names like Atul, Pidilite, PI Industries, Aarti, SRF even, I think many of us, at least I did not look at them. I wish I had. Because they are in a niche where others can't really get in so easily. That is, I think, one of their advantages.
Which I found very fascinating about many of these companies. So they have somehow discovered these niches because of business acumen or luck, I don't know how. But many of them have scaled disproportionately well in some of these categories. So what has helped? So I've tried to compile. So I only gave a list of Indian companies because I didn't want to bore everyone with global companies because they are truly large and very well diversified. But some of these things also apply to them. So if you are a global diversified chemical business, some of the things that have helped you are ability to create new products or discover new applications from the same chemistry of products. So you may be part of the organic chemistry derivatives, and you realize, okay, you can mix these two derivatives and come up with something else which nobody else was marketing or using for this particular application. You may now use that as a product which only you are selling because only you are aware of the process, and you patent that process. Till the process is patented, you are free to make it and charge whatever you want. And you have to put some marketing effort, some distribution effort to convince people in the world that, okay, this process is relevant and should be used. Doesn't happen that often because not too many new products keep coming in the market. So it's rare, but whenever it happens, it makes you disproportionately large amount of money. Technology I just mentioned. Again, sometimes you just need to scale or grow in size in order to become such a large player in the market that you can start dominating the suppliers of the raw material or feedstock by saying that I'm going to buy so much volume from you, I need to get the best price, not the price that people charge at the port while exchanging the product. So I need to get the best prices. So your advantage eventually becomes the cheaper sourcing of raw material. So you are now stepping up in the value chain somehow, but you have not really figured out a way to make more money by being further up in the value chain, but your advantages are stacked up in your favor. You again invest in distribution and branding. So agri-chemical industry is a very decent example for mentioning this point, that they really went into the hinterlands and created these products which are actually commodity chemicals, agri-chemicals, which can be sold with their technical names very easily, but they are like generic medicine. And you branded the generic medicine and it became a slightly valuable product. So that medicine may be off patent, but because it's made by some MNC and everybody says that you should buy a branded medicine, you want to buy that medicine at 4x the price of a local generic medicine. The same thing that happens in agrochemicals or any other chemical which is off patented. You create a distribution network, you brand it well, and you are making money. Some of the advantages that we or the Asian subcontinent has is we have a low cost of labor, and somehow there is a lot of raw material available to create into feedstock and feed your bulk drug ambitions. So yeah, those have helped a lot of players who have slowly shifted their capacities from Europe, US, some of the other developed countries to Asia to take advantage of either scale of manufacturing or somebody who was willing to sell the raw material cheaper to you than what you could produce yourself. So again, don't try and squint your eyes and read it. The idea is to show you the bubbles mention the margin size of margins increasing of the company's revenue or the bubbles. Sorry, margins are over here, and over here is the growth of the industry. So you can see, although specialty chemical industry is a good industry to be in, not all companies will have these good margins sustainably. Not all companies will have growth in the market. Not all companies will be making the kind of high margin growth that we saw in that chart by Michael Mauboussin. So you need to figure out which company you want to invest in, and can you create this matrix for this company, and see if you can visualize this matrix where the company will be in this matrix 10 years from now. So in China, this is from a consultant report, Booz and Company's report. I like this chart because it shows, and this chart is from a couple of years old, but it gives you a trend of what's happened in the past 20 years in the Middle East and the Asian subcontinent, where all these oil and gas companies are going up the value chain, making petrochemicals, increasing capacities. They're competing aggressively in creating these capacities. It's all publicly available, so don't bother taking photos. You can just look it up. Again, they're making basic chemicals, polymers, specialty chemicals. And you can see China and Chinese companies aggressively expanding capacities across the board. Not just in the bulk commodities, but also in specialty and fine chemicals. So most of the APIs that we see in pharma, which are used for the Indian market, for Indian formulations, are actually made in China. Whereas most of the APIs we make here are only for the export market, which are sold as formulations elsewhere. So you clearly see there is a lot of investment going in, a lot of capex happening in all these areas as people try and get into better value chain products. But it is not a free for all kind of a thing. It has its own set of challenges. The fear that every company should have is of becoming a commoditized manufacturer of something. So you may be making a product at one point in time, maybe the most efficient player at that time, or that technology which you found was your own technology to use, but everybody has copied it now, and the product has become commoditized. Everybody can manufacture it at scale. So you won't be able to generate the kind of margins you used to generate earlier. Again, some of the industries just don't scale well. So there may be constraints, like for example, currently environmental constraints really make it hard for you to put up greenfield capacities in areas where chemical plants cannot be put up now. But 20 years back, you would have bought that land, you could have put up a chemical plant there because the effluent treatment or emission standards were not as stringent. So now you are at a loss, whether you expand your existing plant, reconvert it to a new technology or a new product you want to sell, or you acquire somebody else to get the technology or get the manufacturing capacity. So you have to comply with regulations locally, and if you, God forbid, are selling in the export markets, you have to also comply to the requirement of the customer in that market. So you may have heard this term ESG, environment, social and governance standards, which are now being followed by most companies, and investors are forcing companies to follow these standards. Each of them will have a set of parameters under which even the vendor that you buy from needs to be compliant to these standards for you to sell in your market. So each person's supply chain becomes now needlessly more complicated, or deservedly more complicated, if they can figure it out and still charge the same prices that they can. In many cases, prices of commodities do not change that often. So if you are used to buying a toothpaste for 50 bucks, the white Colgate for 50 bucks, it will always remain 50 bucks. Even a little bit of increase, you may not want to pay that much money. But they may then try and innovate something. You put sparkles, crystals, salt, koila, whatever you can find, you put it in the paste and you can charge disproportionately large amount of money. So just imagine that at a different scale where you are a bulk drug manufacturer. You can't do much about the product. You keep selling at the old prices, but with new costs. So like I said, 4% as a percentage of sales is not a great expenditure for R&D, but there is not too much scope also to do R&D. So in India, at least, I have not seen companies having a very strong R&D culture that they really are talking about innovating technology. Some of them talk about processes, but these are all processes borrowed from their partners globally, and they are trying to make it in India because we have a slightly lax regulatory structure as compared to developed countries. So it's mostly a regulatory arbitrage rather than a true intentioned R&D. So don't want to bore you too much. This is again data completely available. The point is, people try to consolidate their products when they realize they are commoditized, they cannot grow in those products. the supply chains become too complex to manage, so they realize, okay, let's hive off this business, sell it to a separate entity who wants to grow in that area, and my supply chain becomes that less complex. You want to increase your market reach, so an Indian company will acquire a Brazilian company, Brazilian will acquire a Swiss company, Chinese will acquire a Swiss company, all these things keep happening. You increase your market. Sometimes you also do it for avoiding to be bought by another company which you don't want to be part of. So Syngenta was bought by a Chinese company when Monsanto was also in the race to buy it, but they did not want to become an American company for some reason. So they went to the Chinese. You also may want to acquire distribution rights or markets where you want to sell your brands where you're not present before. You can do that by acquiring somebody over there. You can access technology by acquiring a better technology product company and their research. And lastly, shareholders might force you to break apart because they want value creation. So, or they want ESG, and some of your suppliers may not be ESG compliant. So you may want to break up yourself or consolidate yourself based on various of these challenges. So Deloitte releases this study once every year. Don't bother to read this. This is showing it because it has a good trend of data. So far they have released it for 8 years and they continue to release it. This is the latest report of 2019, which talks about 2018 and before that. So I keep tracking this to understand what people are doing in the space, what acquisitions are happening. And the reports are detailed, fairly detailed, to give you a broader understanding of what is happening. One interesting thing that comes out of it is a lot of times the data is available, but you don't get the value of all transactions. So you may be tracking or owning a company in a specific subsector of the chemical industry, and some acquisitions happen there, and you may want to benchmark the acquisitions with the current market price of your company or expected price of your company, but data is not available. So some of these trends might help you that, okay, where is the EV per EBITDA multiple going over a period of time? So since 1998 it has been inching upwards. Now it's hovering somewhere in the 10x or 9x band. So which is interesting. Acquisitions are becoming more expensive. Consolidation is not as easy as it looks. And you have to pay up sometimes. Again, geographical, they break it up in various categories. So please feel free to look it up. So that's coming to the end of the presentation. Just wanted to give you some perspective that these are sources available. I'll put up the slides on the YouTube link so that you will be able to look it up yourself. If you ever feel and you are impressed about your ability to now track the chemical sector, please do that experiment of scaling yourself from 1 to 7 before starting opening any annual report. Like, how well do I know this company? वो कल वो Twitter पे किसी ने बोला था, so I know everything about this company. Or okay, on a scale of 1 to 7, I don't know anything about the company. Now I want to study. But then you have that map of that value chain in your mind, that where you are upstream or downstream or somewhere midstream, floating in a pool of chemicals. Special mention, sorry. So there are 3 things which I really found interesting, which I was not looking for, but they suddenly came in Google search, and I, like the serendipity of the internet, helped me understand these things. So there is a report which is released by UNEP, which is the Environment Program of the United Nations. I had no idea it existed, but because it came up in the report, now I know that there is a report which they have released. This is a 700-page report on global chemicals outlook, and this is apparently report number 2. So I don't know how big the report number 1 is. So report number 2 has all the possible chemical businesses and countries in the world. They have summarized everything regarding what policy framework exists in their countries, what it was before, where it is trending now. And imagine the data, if you're an entrepreneur and you're planning to expand, some basic idea is available in your mind to start investigating a little bit more. Again, a lot of these trade journals and even associations of different chemical subsegments have a lot of resources on their websites, generally as free or published articles, so you can subscribe to their magazine and learn a lot of these things on your own. A very badly formatted report from Indian National Academy of Engineering talks about the R&D culture in India. It's an old report, but it's interesting to see that we don't have an R&D culture. It just validates some of the things that we learn anyway while looking at the businesses. And one report by Avendus which summarizes the chemical sector from profitability point of view. It's a good report with a lot of charts, good stuff to read. So, I hope you don't have any questions. Okay, Rajiv has a question.
All of these are Bangalore and Delhi questions, so we'll give them a head start today.
Yes, yes.
So, Mr. Biju from Bangalore is asking, all this GAN is okay, how do we value the chemical company? So, the first part is my addition, all this GAN is okay. He's asking, how do we actually value a chemical company?
Okay, all the GAN is not okay. You really need to watch Breaking Bad and all the 6 seasons of Breaking Bad to come up to this idea that this industry exists. But to be very fair, some benchmarking with relative comparisons of the same industry can be done. I am looking at this camera. I am assuming they are looking at the YouTube feed. Some comparisons can be made by relative valuation. Some comparisons can be made by very rudimentary analysis of cash flows and earnings and their possibility of growing. And I think most of the companies in the industry are valued at some of the peak valuations that they have seen ever in their lives. So nobody would have believed chemical companies would be at 40 times, 50 times earnings in India. So maybe it's a boom time right now. Wait for the right opportunity. But I think the bigger challenge is to understand the value chain first. If you figure it out, valuation will come naturally.
Okay. There's a question from Mr. Karthik Vora of Delhi. He's asking, what's your comment on the China advantage? Is it here to stay for companies like Nocil, etc., or will it not move the needle?
So I don't know about company-specific advantages, but many companies in the past 2 to 3 years have benefited tremendously because of shutdown in capacities in China, either from a final product point of view, where they were competing with Chinese players, or in sourcing raw materials competitively from elsewhere, but still being able to manufacture in the market and selling that raw material, which now became expensive in the market. So a lot of advantages were available. I don't think these things can last. Because if you now read, so if you track some companies specifically from China who had shut down their plants, you can actually see they have been relocated somewhere. The plants have been literally, it seems like they've been airlifted and put in a new location overnight. And they are starting capacity of probably 2x or 3x the size because they know that they have to cover up the entire segment now. So it's not going to last. But in some cases, Indian companies might face similar obligations to maintain same standards for environmental pollution. So just because somebody else is not allowed to pollute, you are supposed to pollute is not the right business strategy for investing. So I think I have to walk cautiously and figure out each company's supply chain independently.
Okay, Alok, who's today in Delhi, is asking almost a yes-no question. Would paints be part of chemical industry?
Yes.
Okay. There's a question from Mr. Venkatesh from Bangalore. He's asking, what is the potential for India after accounting for the impact of pollution?
Not sure how to answer it because we are not truly facing an impact of pollution at the same scale or same severity as it is in China. But although if you are able to pass on some of these extra costs that you have because of the pollution processes that you have implemented, you may be able to survive and grow in the existing categories. The challenge here is, can you move up the value chain? Do you have enough capital left from the existing operations? Or can you raise capital at the right time to scale beyond your current business and go into a higher value-added business and thereby stopping manufacturing of those polluting chemicals? I think you have an advantage, but that is easier said than done. It doesn't happen that dramatically. You really have to go company by company specific data and understanding where they are in the entire map of chemicals that we saw and how they are planning to expand in that category. And many times you are just trapped. You may not have enough capital, may not have enough willpower to do it, may not have management bandwidth, a lot of things you may not have with your, or you may not have land to buy. So a lot of things have to be figured out before I can answer that question. So I don't know. Short answer.
Mr. Srinivas from Bangalore again has a somewhat stock specific question. He's asking, it has been difficult to identify what makes a chemical stock breakout. I assume not technically or stock price, but in business fundamentals. He's saying, I'm very happy with how Vinati has done, but can't satisfy myself about the future.
That's a good comment. I agree with you. I don't know.
Okay. There's a question, Mr. Prashant from Bangalore. He's asking, where are we in the capital cycle? Will we see sudden capacity addition across companies and subsectors?
There is actually a huge capacity addition happening in India. A lot of companies in many of the categories are actually going to double their capacity in the next 3 to 4 years. And it's interesting because they are confident. I mean, of course, they see the market better than an analyst can. They seem to be very confident about their prospects in this industry. So yeah, there's probably $4 to $5 billion worth of capacity added in the next 3 to 4 years.
Okay, Mr. Parmeshwaran, again from Bangalore, wants your view on UPL acquisition of Arysta.
So, like I said, you may acquire a company for several reasons. This is not an exhaustive list of reasons to acquire something, but you may want to go into a new market, acquire new products, acquire research technology, go up the value chain somehow. I don't know, these are noble intentions, but I don't know if you can pay your way to do that, especially when you are not certain about how it will plan out. Most acquisitions don't work, so it's very risky to figure out at a higher valuation if you have to acquire something and the multiples keep increasing. So, to be very honest, I've seen the business, but I don't understand how it makes sense from a valuation point of view. But of course, promoters know better than an analyst can. I hope they do well.
And last one from the remote locations. Mr. Biju wants to know, how about environmental factors and government affecting chemical industry like it affected Rain Industries? I guess you have covered it, but maybe if there's anything to add.
So there are some interesting specific things happening in India as well. So if you talk to company managements about environmental compliance, you will get a very different picture. You will suddenly see India being a top-notch regulator in terms of environmental compliance. So if you go to the Central Pollution Control Board's website and go to the chemical sector, you will see a very updated list of specific subsectors and industries which have a specific compliance range given, that you can only pollute to some extent, and these ranges keep updating based on local conditions. So the enforcement has to be done by the state pollution control boards, and the state pollution control boards are now demanding many of these players to have live sensors which they can monitor remotely from their offices, that in terms of how much pollution they are putting up in the atmosphere or how much effluents they are discharging with the right chemical composition which they are allowed to discharge. And since these things keep changing, the promoters or the operators of the plant really need to be aware, or they might face an inspection or a fine. So I don't know if it is as strict as the US FDA kind of a raid that happens on a pharma company and suddenly the stock tanks 20%. I don't know if it's that severe, but yeah, it is getting that challenging or that advanced in our country as well. So it's very strict now. It's actually really difficult to run a chemical business in the old Wild West kind of a way.
I'll just creep in one last question which has just come in. Mr. Karthik wants to know, is it possible to find moats within brackets cash machines in upstream chemical companies, or will there always be cyclicality of some kind?
I think the moat here is your ability to charge more money over a period of time and not losing that ability. So in upstream companies, most of them are driven by scale and ability to generate cheap raw material. So if you are a refiner right at the wellhead where you are getting oil from, your costs of supply, getting the oil are much cheaper than somebody who has to ship oil from point A to point B. So if you can understand the supply chain well, you will be able to figure out the moat, and hopefully nobody else finds it before you do. So all the best. But I'm amazed by the attendance in Bangalore and Delhi. Superb. Thanks, guys. Wait. Any questions here? Yeah, please.
Actually, I must congratulate you. You've done a phenomenal job. It's a very tough analysis because it's not homogeneous.
Yes.
My question is this, that, out of those companies which you have highlighted, there are about 5-6 of them which are really doing very well since the last 10 years.
Yeah.
They seem to be growing. So I know it's not a fair question, but naturally we have to ask you tough questions. Do you think even at these prices one should get in looking at the next 5 years? Looking at SRF, Aarti, Vinati, PI, Atul. I mean, I'm looking at these 4 or 5.
So you are free to ask tough questions.
Yeah.
Thank you for the comments. Not necessarily I'll be able to answer them, but one reason why a column is missing, which I wanted to put on the extreme right, was the multiples, earnings multiple and cash flow multiples. I didn't put that. I really wanted to put it there, but I said, okay, let's just let these numbers pop your eyes other than the multiples, which are very depressing. So if you look at the PE band, or the earnings band or a cash flow band of these companies over the past 10 years, this has been the past few years have been the most extravagant re-rating in some of the multiples. I don't know if they can last. So frankly, from like I said, that wheel of fortune where people praise high multiple stocks and extrapolate faster into the future, I don't know. Although at the same time, most of these companies are really good businesses. They are actually doing the right things in terms of making value-added products, trying to expand themselves into different areas of their own value chain. So I like that. So tracking them is good and understanding the industry is better from that point of view. But really it's very hard to predict the growth can sustain or not. Mathematically, it doesn't seem so. It might sustain because it will hit the ceiling of the industry, and they may have to acquire something larger to make sure that they keep growing at a different rate. But they have grown. So, despite all the challenges that we have seen.
Thank you for the presentation, Ronak. With today's CS report on SRF, PI and Aarti Industries, since the results of some of the chemical companies just came in last week and this week, Vinati was one of the company which told that they have some of the products which actually have no competition.
Right.
Okay. SRF has told that in yesterday evening in Concall they have told that they see the revenue growth in chemical business to be around 40 to 45%, 20 to 25% in fluorochemical business. So, I mean, also I wanted to talk about this small cap company Fine Organics, specialty chemicals. They came up with this IPO last year only. So, you did mention that the global size of chemical business is around 3 trillion, I guess. Right?
The entire industry,
yeah,
including commodity, bulk,
so
stock.
I mean, as Sir asked over here, that entering at this prices because already pretty much all of them are trading near 52-week high. You know, in next 5 years, 7 years, or maybe 10 years point of view, where do you see the market size? I mean, if at all you have any idea on this aspect.
So, it's actually a very easy question to answer because any number will satisfy you because we don't know how fast the industries are growing. But to be fair, most of these companies, so when I wanted to find data about specific subsegments, I went through the reports where some numbers were mentioned. And most of the times, some of the industries were growing at 5% CAGR over the past 5-6 years. Some grew at 4%, some grew at 3%, some grew at 10%, depending on the value chain where they were. So I think the average growth rate has been about 3.5 to 4% in many of the categories. Some of them have degrown because industries have consolidated, companies have vacated the market. So tough question to give a macro answer which is reliable because any answer will work. Anybody's guess will be as good as mine. Unless we go specifically into each company's supply chain and understand what they are doing. Like you mentioned a few names, I have not tracked them that deeply, but they do exist in the supply chain somewhere and you need to understand what they make, where it is used, why are they making it, did they get some patent or did it come up to them in their night, suddenly realize, okay, I'm going to wake up tomorrow and start this Fine Organic company or whatever. How did they actually become what they are today? And why do they deserve the kind of margins, why do they deserve the kind of growth that they are getting? Some of these questions get answered when you start digging into the supply chain. I think it becomes relevant to look at the entry points and exit points, but it becomes dramatically boring because you are then anchored to the multiples and what the market thinks, and you're playing that stock market game that, you know, मैं आज लूँगा, its capacity will be 2x next year, assuming that probability of 50% they will do well, I will assign some metric. I mean, you can keep playing with the numbers on an Excel sheet and satisfy yourself and invest. I think the bigger challenge is to figure out what is the real benchmark for most of these industries, where they were trading 5 years back or 10 years back. I mean, we were using the same chemicals today, we are using them today, and they were existing 5 years ago. So what happened? Why sudden the fancy or love for these companies? So if you really understand some of these stock market dynamics and remove them from your decision making, you may be able to actually keep a list of companies, like grocery list, that okay, when it falls within this acceptable valuation range, you might want to buy this company because this company has a better chance of trending up in the value chain. And I am actually welcoming people in the audience who have tried this sector before. Please put your inputs in because it's a very hard question to answer. So anybody wants to answer this question, please feel welcome. Wow. Yes, Shail.
You know, I have a question about the fertilizer industry. When will it start making fair returns on investment? Because the kind of mess it is in, India is forced to import fertilizer. You know, people are not making enough investment.
So many of the challenges that we saw which industries are facing are also from the regulatory point of view. But most important is the feedstock. The feedstock in India is very expensive, which is a derivative of natural gas or naphtha, whatever. So that for at least nitrogen-based fertilizers, we don't have a great kind of mining capability for potash. So we have to import that. Some of these things we're anyway importing. So in the past few years, many of the bulk commodity suppliers or the feedstock suppliers have made more money by supplying to these industries. Or they've actually, like you said, imported the fertilizer but made somewhere where the feedstock is cheaper. So I think sometimes you just have to vacate the industry because you may not be competitive irrespective of what you do until your raw material issues are solved. So government might give you subsidy, you can create lots of incentives for surviving in the industry. But if you want to survive, you might as well survive in a better quality business where you have some scope to grow. So for example, suddenly turning off the tap on the gas in many of these companies making nitrogen-based fertilizers, your raw material is stopped. You cannot buy it locally. You have already committed to buy, and you cannot even buy it at the same quantity abroad. You are losing cash flows every day. Your debt clock is ticking. You want to keep repaying your interest on time. So all these things keep affecting the business more often. And I don't know when that cycle will end. But from a supply chain point of view, it's very hard for the industry to keep doing well. But the demand is clearly there. The agriculture business is clearly growing. So they need to figure it out. And if it's the solution is to vacate the market, maybe the existing players, remaining players might keep doing well.
I have one more question. We don't see many MNC names in your list. Why they have not done well in this industry?
So MNC companies globally, I think the problem was the companies were already too big and too diversified with extremely complex supply chains. So there are categories within the MNC companies which are like 100% ROE kind of businesses. There is no investment required, but they don't grow. So they don't create incremental return on capital for them as the companies are expanding. And what they are facing challenges are they have to shut their operations in one part of the world and invest elsewhere. So a company like BASF will have operations now more in size in China and India than they have in their native country. So that supply chain complexity is already added to that list. But compensating to that, the raw material costs have come down. You have become more efficient in managing the transfer of volume of commodities everywhere else. And plus, you have now access to the domestic market demand, which is there. So all these things have also benefited. So they have done well on a group level, but you may not have seen many companies do well domestically for several reasons. So one of the reasons was not trusting what they are doing. So 3M India, for example, the company did very well in the stock market, but they have a very limited set of products in India. They actually sell a vast number of products. I think 10x more products that they have globally, and they only sell 1/10 in India. So they have no idea if they are going to expand the categories or not, because each category will require local supply chain to be built. So I don't know when that will happen. So some of these companies independently might do well, but most of them have done well at the parent level. At the parent level, the capital allocation is far better. So they do buybacks. They actually have very lean balance sheets. They in fact borrow cheaper money to make sure that the operations and shareholder returns are taken care of, which they don't have advantage in India, or they are reluctant to do it in India.
I'll just add a point to the previous question, the fertilizer one. You have also highlighted it on the feedstock. So at a natural gas conference a few years back, one of the fertilizer manufacturers gave this very good insight. He mentioned that, see, as such, we are importers of petroleum-based products, natural gas as well as crude oil. Now, one of the cheapest ways of making urea or bulk of the fertilizers is using natural gas as feedstock instead of naphtha. Now, natural gas to transport is very difficult. At the wellhead, it may cost 50 cents per MMBTU or 75 cents per MMBTU. The transportation cost of that, because it has to be cooled, I think, to minus whatever, so many degrees centigrade, it has to be kept at that low temperature and transported in special LNG carriers, regasified once it reaches Indian shores, and then given to fertilizer companies. So when what costs 50 cents or 75 cents or maybe $1 at wellhead, by the time it reaches Indian shores, it costs $3.5, $4. If you transport fertilizer that's a powder which can go in any dry bulk carrier. So if we are anyway going to import, why not import fertilizer as compared to importing natural gas? And actually JVs have been made. So IFCO, which is a big fertilizer cooperative, has formed a JV in Oman. It's called OMIFCO, and they have assured a offtake of fertilizer to that company so that they don't worry about marketing the output. And it's at the wellhead where the fertilizer is produced right then and there. So just wanted to add a point there.
Actually, I have been studying this fertilizer business for a few years. It's going to be a big disruptive change in the next 5 years. Total import of urea is about 5 million tons. Production is about 25 million. It's sold at 6 rupees a kilo, and I think the subsidy is about 4 rupees a kilo. Biofertilizers are going to come into a big way. I'm advising a company in America and Germany. We are setting up a plant in UP where we are setting up 100 plants. We will be making 10 million tons of biofertilizer. Now, biofertilizer is half the cost of urea, plus the nitrogen is double the FS. You mean the nitrogen which has effectiveness in biofertilizer is double of urea. So the farmer will benefit a lot. For example, I'll just give you one example and stop. Around Delhi, about 60 million tons of straw is burnt every year. In Haryana, Punjab, UP. Now we have written to the state governments, you give us the straw, we will pay 1,000 rupees a ton to the farmers, and out of that 50 million tons of straw, we'll convert it into 40 million tons of biofertilizer. And this will be at a very low cost. We will also be producing CNG gas. So that is going to happen in the next 5 to 10 years, and the HBJ pipeline will not be required at all. And most of the 34 urea plants in India will stop.
Cool. Thank you.
Questions?
We'll take one last question. They're actually well ahead of every month's time. Sorry, please ask.
I have one question. This is regarding the entire format which you just showed on inorganic oil and gas, industrial gases.
This one?
Yeah, this one.
Okay.
So I'd like to know where you would place Reliance and the petrochemicals that it produces in terms of this chart, and how do you see it disrupting the rest of the pack, which is based on those petrochemicals as well?
So where does Reliance figure out in this, and how will they disrupt?
Right.
Second answer is very easy. I don't know, because I've not studied that sector very well. They mostly will be over here, over here, kind of somewhere in between, where they are making all the petrochemicals from the feed that they're getting. I think they rely on the feed from outside, so they don't have their own source of the feed. They buy it from somewhere else. So might be if somebody opens, so like SABIC, for example, the Saudi Arabian holding company, which also is investing equivalent capacities, they may have a better advantage if they are slightly more advantageous for them to make it closer to the fuel source. I don't know. So a lot of things happen in the industry in terms of where they are and what kind of mix, like a product mix and volume also matters a lot over here. So I have not figured that out, but there are other alternatives available at the same scale elsewhere, which are closer to the fuel. So if they can go up the value chain somehow, it might help them. Cool. Thanks, guys. Thanks for the patient listening. One last question, sorry.
No, we are using a lot of plastics, and you must have seen a lot of videos floating around in WhatsApp groups about the non-biodegradability of the plastics, and they last for thousands of years, and this is becoming a crisis. So have you seen any disruption happening in terms of alternatives to these plastic packaging material, which will be a threat to existing players like Reliance, for example?
So there
and also good for the environment. I mean, we need something better than the traditional plastics.
So there are two ways of looking at this argument. So I distaste the same thing. like how WhatsApp messages float, plastic also keeps floating everywhere, and it's horrible to land up in the marine life somewhere. The ways of looking at it, so one argument at it is that you ban plastic summarily, reduce the supply of the item, so demand automatically will move to something else. The other argument is if you are going to say cotton-based reusable stuff or paper or whatever, each industry has its own carbon footprint. So every supply chain is not innocent in terms of creating the carbon footprint. So now when you zoom out and see the carbon footprint of each supply chain of plastic, paper, cotton, everything, each may have certain disadvantages. So I think most of it is also habit driven. If you can create better incentives for people to behave in a different way with this material, you may actually have a better compliance for not throwing plastic, or you can reuse the plastic. If it lasts for 1,000 years, why not reuse it? Rather than something that doesn't last that long and you use it and throw again. So most of it is also a product of the 30, 40 years ago when people were starting to appreciate the impact of plastic in their life. And now that we've realized it's overused in some way, one is the behavioral way of using the plastic, but the other end is, do we really understand the supply chain impact? So people generally blame policymakers saying that, okay, you guys should do something about plastic, but really are the other supply chains geared up to become green at the same time to really benefit the environment? So I don't know, I'm somewhere on the fence to understand how it really works. If I come across something, I'll share it with you.
I'm particularly distressed about those 5 rupee, 10 rupee packet pouches, which are completely, they have BOPP and metallized, which are really non-biodegradable, and you're spreading them across India. This, with the increasing consumerism and all.
Yeah.
So single-use thing, and there's no alternative to it as of now.
The alternatives exist, but then they cost more. So, so your product margins, if you are a seller of those products like chips or whatever, and you're packing in those material, you have factored in your product margins based on the packaging cost. And generally, packaging cost does not go beyond 1.5–2% of the overall cost of the product. If you're willing to pay more, if the customers are also willing to pay more, knowing consciously that this decision is made because of that, and I don't think people think that way. If somebody suddenly charges you 5 rupees extra for something, we may be put off if the thing was 10 rupees earlier because the packaging has changed. I don't think people accept that. So the behavioral change has to be inculcated first as to why do you want to charge more? Is there a narrative you can create? So probably invest more in marketing and showing that this is how this particular packaging material is made. This is the impact of each bag of chips you eat, and probably then replace that with a new bag of chips which is environmentally friendly or whatever. I mean, there are ways of doing it. I'm pretty sure people are clever enough, but I think the incentives need to be aligned properly. I think thanks so much, guys. Thanks for the patient listening. Do watch Breaking Bad. Help you understand the specialty chemicals industry very well. And one more thing, sorry. Yeah, the next FOF is on 13th of June, Thursday. So please mark your calendars. Thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.